I'm Mike Almale, back with another lesson in this mercifully brief introduction to financial accounting. In accrual accounting, revenue is recorded when earned. Customers' or clients' obligation to pay for goods and services provided is called accounts receivable. From the firm's point of view, accounts receivable are assets. When a business extends credit to its customers, it assumes a certain risk that it may not be able to collect what is owed. Why would a business be willing to let customers wait to pay for goods and services they have already received? Perhaps you've seen the sign over a business counter that says, "In God we trust, all others pay cash." Indeed, it would seem like a more prudent business practice to insist on cash payment as soon as goods or services are delivered, or even better yet, why not be paid for goods and services before they're delivered? Generally, firms extend credit to customers or clients simply because they have to. If a business refuses to extend credit, it may lose customers to competitors who do. Many managers conclude that the additional revenue made by extending credit outweigh the cost of non-collection of receivables. When a business extends credit to its customers, it records a revenue transaction at the time it provides its customers with goods or services. The transaction results in a revenue account increase and an increase in an asset account. Since no cash is received, the asset account that is increased is accounts receivable. Here is an example. When Joint Ventures made its December delivery for Colombian Growers Co-op, they did not pay them the balance until January. When the delivery was completed, the co-op had an obligation to pay Joint Ventures for its services. Joint Ventures completed the $50,000 delivery on December 20th. Recall that the co-op had already paid $5,000 on the delivery, so on December 20th, the following journal entry would be made. Notice that no cash account was involved in the transaction because no cash changed hand. An asset account was increased and an equity, revenue, was increased as well. Here in general journal format is how this transaction is recorded. Now, if on January 5th the co-op paid the $45,000 owed, the transaction would be recorded this way. Now notice that no revenue account was affected by the January payment. This is because the revenue was recorded in December when Joint Ventures actually earned it. In January, all that happened was that one asset account, cash, increased, while another asset account, accounts receivable, decreased. Reflecting accounts receivable can create valuation problems and the potential for management mischief. The valuation problem stems from the fact that sometimes customers fail to make good on what they owe. This failure to pay may be willful, but often it is not. Usually customers intend to pay for the goods and services they acquire, but due to unforeseen economic setbacks or failure to adequately control spending, they find themselves unable to make payments. This very ordinary circumstance creates a valuation problem. Let's say that a firm has $15,000 of receivables at the end of an accounting period. Can the firm determine if these receivables are fully collectible? If the accounts receivable are not fully collectible, assets and revenue are overstated. Arriving at a reasonable valuation of accounts receivable usually is not that difficult, but getting a precise dollar amount of collectible accounts is not usually possible. Welcome to the world of accounting estimates. A figure for accounts receivable on a balance sheet of a company with a large number of individual accounts reflects an estimate of what the company believes is collectible. Now, you hope that the estimate is made in good faith and is reasonable. The most common method of estimating the collectibility of receivables is to use an aging schedule. In an aging schedule, accounts receivable are classified in terms of how long they have been outstanding. A typical schedule divides receivables into categories of less than 30 days, 31 to 60 days, 61 to 90 days, and over 90 days. Now, based on general credit experience, the longer a receivable is outstanding, the less chance for full collection. For example, let's say that Joint Ventures accounts receivable total $75,000 at the end of the most recent year. Based on past credit experience, the owner estimates that 90% of the receivables under 30 days will be paid, 70% of those between 31 and 60 days will be paid, 60% of those between 61 and 90 days will be paid, and only 50% of those over 90 days will be paid. If the distribution of the $75,000 receivable is broken down on an aging schedule, Joint Ventures would estimate the collectible receivables as follows. Now, sometimes managers do not act in good faith and they inflate the amount of receivables they deem to be collectible. This results in an overstatement of both assets and revenues. Sometimes the valuation question may go beyond simply making a good faith estimate of collectability. In some situations, management may be tempted to commit outright fraud. Because no cash is collected when sales are made on account, a corrupt management can record fraudulent additional sales by simply creating fictitious customers and/or fictitious sales. Another time-honored means of inflating accounts receivable and sales revenue involves what is known as keeping the books open at the end of the accounting period. In this case, the customers and sales are real, but January's sales are recorded as December sales, so that end-of-year financial statements include inflated assets and revenue. Part of the audit function is to test the existence and collectability of accounts receivable, and this can serve as a brake on such fraudulent practices. In the audit of large companies with millions of dollars of receivables and hundreds of thousands of individual accounts, the audit process relies on statistical sampling, which usually provides a reasonable but not exact estimate of collectible accounts. So click here for the next lesson.